Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. Milind, great having you. I hope all is safe.
Hi, all is safe. Thank you. I hope same thing with you as well.
Yeah, all good, Milind. Thank you. Milind, that's the question really. Did you mean to say that it's now time to bet on proven execution capabilities which are there and tangible as opposed to stories in sectors, in themes, in companies which may play out subject to XYZ happening? Is that the central theme?
Yes, I think so. Because as I always say that I'm a student of history, especially when it comes to the equity markets. And we have seen that at least in last 25, 30 years, that whenever we see euphoria around IPOs, we have always seen that the market corrects going forward in the next few months. So I don't think this time it's different. It's always the same. And that is the reason why I think that it's time to move from story to substance. Other reason probably is also that one should remember the previous booms and busts which happened across the globe. Like it was the tech boom in 1960s, it was the tech boom in 2000s, and of course there was also, for example, uh, take for example Amazon. Now, if one invested in Amazon in 1999, it was roughly about $100, and after the internet boom got over, you were probably losing 80% of your capital for a very long period of time, and you started making money only back in, I think, 2010. So it was almost 10 years where you had to sort of lick your wounds. So that is the reason why I think that one should be careful, because though I mean, when the IPOs come in, people say that so what if it goes down, we'll hold on, we are long-term investors. But frankly, most of the investors get jittery if the markets actually start coming down. So that is the reason why I think it's time to move from story to substance.
So, Milind, in which case, that would be my question to you. Where do you believe that there is a lot of hype and story as opposed to there being actual substance? Are there pockets out there? And question two is, do you also sense that there is a bit of a valuation discomfort there, or is that the valuations may be okay, but because the story might not turn out to be true, it's better to not bet on that?
Yeah, so valuations, I always believe, is after considering growth. So I won't say that every time the current PEs are what one should look at, but one should look at whether the company can make money over the longer period of time. So if the answer to that is yes, you can definitely hold on to these companies or invest in these companies. But valuations do matter. So let's talk about platform companies. So I have been bullish on platform companies, but like I told you last time, that platform is another way of doing business. So the business underlying the platform needs to be solid. So whether it is brokerages, whether it's retail, so these are solid businesses, and platforms are enablers for them to grow, and to grow significantly faster and significantly higher. So these platforms probably have substance in them, but there will be a lot of others where there may not be a substance, at least in the shorter period of time. Or when I say substance, what I mean is that they will not generate cash flows for a good mid to long term. Those are the companies you should I wouldn't say you should be scared of, but you should be willing to hold on to these companies for 8-10 years if you are okay with that. But that's what happens normally, because it's especially for small investors, because small investors I have seen in a boom turn small speculators, and that is the reason why one needs to be careful.
Man, how are you approaching, say, for example, I'm not asking for a recommendation here, but the approach to a Zomato, for example, or any such company that will get listed. One, a platform. Two, habit creating. Three, Loss making, yes, but the whole crackdown that China has done on some of its own platform companies,
Yeah.
does that increase the relative attractiveness in the minds of global investors towards, say, a market like India and a company operating within that landscape? And therefore, much as people may like to hate a loss making platform company in India, because there are few of them, they might still find global appetite, even if not local appetite.
Yes, it's possible. But tomorrow, if companies in US also start coming down, because many of these platforms trade at 60 times, 100 times sales. So if they actually start coming down, then I don't think they can sustain in India as well. So that is the reason why I'm saying that you ought to be careful. Take, for example, the education platforms where there has been a clampdown in the US, or fintechs also, where there has been a clampdown in China. I'm sorry, the earlier was also China. So in India, for example, edutechs. Now, as of now, what is happening is that because even education is from home, that is why these companies have become extremely popular. I don't know what will happen when we return back to normalcy. So again, education platform is a good platform because it ultimately it will never replace schools, but it will replace maybe coaching classes. So there is some kind of a substance there. But if the company is not making money as of now, you may have to hold it for a longer period. So I'm not saying that if the business is good, these companies will not make money. But remember, it will take a very long time for them to make money. So in the meantime, the valuations could come down, and that, I think, is a caution which everyone should remember. And that, because even in the internet boom, we had a lot of retailing companies which were only on the net, and most of them virtually vanished in 2 3 years. There were companies which sustained, like Amazon. Google came in a bit later, but yeah. So these are the companies who sustained and returned pretty decent money to the shareholders. But you need to weed out these companies and weed out the dirt and then hold on to the winners. So that's what it is. So rather than that, I think if the economy is going to do well, maybe you should look at the other side as well.
Okay, Milind, just before I come to the other side, one quick follow-up, right? The Paytm
Yeah.
IPO, and let's say fintech becomes a large sector. At the
Yeah.
other end, in the con call, Bajaj Finance says that I already have a robust existing on the ground business, and I'm
Correct.
building a tech platform on top of that, right? So if you're willing to give an X valuation to a company like Paytm or some of the others, which we don't know when will make profits, as against that, we have a robust profit-making company which is building the tech platform on top of it. Can the two at some point of time reach a stage wherein people might want to believe that basic on the ground companies which are now becoming tech enabled and maybe tech fronted can get great valuations? And why not? Because they are actually profit making tech companies.
Yes, I agree, definitely. So in fintech, I mean, the answer is still to be found whether the startups will make more money or the established players will make more money. But if I'm not mistaken, off late, whatever large deals are happening in the US are in established players who are into fintech. So I think that is what will happen in India as well. Because take, for example, co-lending. I think it will be established players which probably will have a better sort of a better ground with banks to partner with them, rather than you could say a smaller or a startup. So I would rather bet on an established player who is getting into a platform, rather than a completely new player who has just come out with a platform. There will be winners there as well, but then you have to be very, very choosy there. It's rather better to bet on a company which has a solid basic background, and they are improving on their technology, or they are building on their platform. So yeah, I agree that these are the companies which will give you higher valuations over a longer period.
Got it. Milind, what about what about the other side then? Therefore, I mean, what do you mean when you say that people should look at the other side? Where is it that you might find comfort? The reason I asked this, Milind, also is that
Yeah.
for the longest time, and by the longest time I mean the last 6 to 9 odd months, there has been a big hope trade on the economy opening up and the consumption stocks which benefit out of the pent up demand. Hotels, cinema,
True.
multiplexes,
True.
restaurants, what have you, doing well. That wait has gotten fairly long now. What do you mean when you say that you look at the other side and combine that with your view on what to do with some of these businesses that are directly linked squarely to people going out and being able to spend again?
So what I think is that there will be a distinct move from unorganized to organized in this field, uh, whether it's shoes manufacturers, whether it's jewelry manufacturers, or jewelry retailers, shoe retailers. Everywhere we will see a move from unorganized to organized. Yes, the wait has got a bit longer than what was expected. But again, if you see that, again, I go back to the Spanish flu, which lasted for almost 2 years. So we are about 1.5 years. The flu refuses to go. But at the same time, at least in India, we are now seeing some kind of cases coming down. But it will probably be still more time before we return back to normalcy. But once normalcy returns, at least in history, we have seen that there is a crazy urge to spend amongst the population, and I don't think this time it will be different. It will be the same. So yes, the wait has got a bit longer, but I don't think that the business proposition still continues, and that is the reason why these stocks will continue to do well. Why may they will continue to do very well over a longer period of time. And of course, I am also bullish on the entire markets, though I am saying that it's time to be cautious, because again, between 2003 to 2008, though the market went up close to 6 times, there were at least 3 to 4 times that the market corrected significantly. And when I'm saying significantly, it's anywhere between 18 to 25%. So again, this time won't be different. So there will be a correction. We have not seen a correction for long. So what pushes it, I don't know, but in all probability, it will be reducing liquidity. That's what I believe, reducing global liquidity.
Okay. So in which case, Milind, would you, with the presumption that you don't take a cash call,
Yeah.
would you stock up a large portion of your portfolio with some defensives right now? Or would you stick with what you believe will do well over a 3-year period, even if there are intermittent connections in between? Because I think from what I understand, you seem to be banking upon a corrective move as the most certain outcome in the near term.
That's correct. But again, so let me again go back to history. So frankly, it's very difficult unless and until you are a very sharp trader. It is very difficult to play these corrections. So what I would do in our portfolio in all probability is that we will continue to hold good quality stocks, because even if a correction comes in, we believe that it will last for not more than 2-3 months and the markets will bounce back. So if I'm comfortable with stocks which will continue to do well over a longer period of time, and I'm not saying my typical long term of 8 to 10 years, but even if I'm comfortable that the stock will do well in the next 2 years, of course, assuming that the pandemic doesn't continue for long, then I will continue to hold the stocks. I will hold the stocks. So no change in the portfolio, apart from let me say that if new money comes in, I'll be more cautious while deploying that.
Got it. Milind, are you moving to the very expensive, I mean, for new money, for example, would you, or even for the existing money, would you continue to hold the very expensive consumption names? They have been performers, all right, but for the longest time, for example, HUL in the last number of quarters now hasn't given any returns, etc. And it does remind me at times of what happened in the last decade or the last to last decade, isn't it? So my question is, the
True.
Asian Paints, the Nestle's, the HULs, Are you comfortable buying there because they do spring a surprise every now and then, or would you believe
So,
more money could be made elsewhere?
so frankly, I'm more bullish on the retail stocks than FMCG stocks, because earlier also I have said that over a longer period of time, retail become the sort of market leaders as compared uh, to these FMCG stocks. So yes, my weightage towards retail will be higher than weightage towards FMCG stocks, but I will also look at for example, pharmaceuticals and some of the other sectors, rather than focusing only on FMCG. Rather, FMCG, I think there is a possibility that FMCG could be underperformers for some time.
Okay. Milind, the other last couple of questions really. One of the queries is around banks. What's your thought here on financial institutions? Do you think banks have heady days ahead, or will they tide over this uncertainty?
So longer term, I think banks banking is the sector to bet on, banking and financial. The reason being that we are betting on increasing per capita income, increasing consumption. So retail centric banks are likely to do very well. And that is the reason why we believe that banking is a sector which one should definitely have overweight in their portfolios. So yes, banking is something which we definitely look at, and we will continue to be overweight on that.
Okay. Milind, my final question, I would want to know what interests a student of history from what is new age currently, so to say. There is electric vehicles, there is biofuels and ethanol, there is this whole PLI backed manufacturing thing. So manufacturing has been there for ages, but the PLI schemes are a bit of a new thing, so to say, that we are getting to understand.
Yeah,
Then tech companies have found a very new avatar of sorts, so to say, wherein the demand seems to be unsatiable across the world. So,
correct.
what is it from amongst the newly developed or recently developed last 12 months phenomenons or 18 months phenomenons that seems the most compelling to you?
So, what I have seen is that the markets normally behave over a longer period of time like Darwin's theory of evolution. So, in the sense that we see, initially they are the basics, which is commodities go up. Then commodities sort of start coming down, and commodified products, that is the users of commodity, they go up. Then they start coming down, and then you have industrial products which go up. And then, of course, in the meanwhile, all the other sectors which depend on consumption continue to be steady and start moving up. So as of now, I think though technology still has, as you rightly said, that a newfound business opportunity, at least for next 2-3 years. So technology will continue to perform. But when it comes to PE expansion, I doubt whether that will happen. But they will be driven by their earnings growth. As far as industrial products are concerned, maybe they will take off. So there could be some investments in industrial products or engineering products as well. And of course, there will be others like pharmaceuticals, chemicals, and things like that. But again, my focus will continue to be on consumption. So as I have always said, that consumption doesn't mean only retail or only FMCG. It also means a lot of other things. So it can be auto. So any selected auto ancillaries will do well. So the whole call is that consumption will drive the Indian economy, and Indian economy overall will do well. So anything which benefits out of that will continue to do well, except the exception of technology, which will do well because of the demand which comes from out of India.
Got it. Milind, lovely talking to you. Thank you so much for your time, and
Thanks.
stay safe,
Thanks,
most
Pankaj.
importantly.
You too.
And
Thank you.
and thanks for joining in.
Thank you. Bye-bye.
Bye bye. And viewers, thanks for tuning in to this edition of The Talking Point.